How's it going, everybody? This is 25 Invested, and today we are with Bradley Talks Money. You may have known him for Blossom. If you're on Blossom and you follow me from Blossom, which most of you do, then you've probably seen at least 100 of this guy's posts. How's it going?
Oh, it's going good. How are you doing?
Good. Good. So we're just going to go through each week on the daily. We're down like everybody else today. On the weekly, we're flat. On the monthly, we're up 3%, 3 months, 5%. Yearly, we're up 18%, and all time, we are up 12%, or $8,428. Looking at the stock holdings, I'm just going to brush through this real quick. Just pause the video if you'd like, and then we're going to go through each holding with Bradley. Maybe not each holding. That would be a super long video. All right, Brad, let's talk a little about yourself first.
Yeah, so since most of you here are probably from Blossom, I'm sure most of you have had the opportunity to interact with me in one way or another, and I hope it's been pretty positive. I work in the financial space. I deal with small businesses most of the time, lots of exposure to different sectors and industries, and I'm pretty much self-taught with investing. I started investing I started buying stocks individually in 2020. I've been investing since I was 18, but doing self-directed investing since 2020, and it's been quite the journey, learning and growing and improving my education along the way.
Very nice. Well, let's just talk about one more. What are your sources? Because most people know what my sources are. YouTube, Maverick of Wall Street, Everything Money, people who are trying to push value investing. So let's talk about who your sources are. Yeah,
so I'm a little bit different in that regard. I tend to pull most of the information that I've educated myself on through books. I try and read as much as possible. Typically, I try and get an hour of reading in before I go to work every morning, and try and consume as much of that information as possible. The reason for that, in my opinion, is just because the people who are writing books and the people who are publishing high-level content have some success in the industry, whereas other content that you can find online is not necessarily sourced from the same quality. So I figured if I want quality results, I have to go after quality sources.
Well, very well said. Yeah, no, that's perfect. And what would you say your style of investing is? So I am a fabricated value investor, a wannabe value investor, and where do you think you sit?
Right. Yeah, I think that you and I kind of relate in that regard. I definitely like to take a value-based approach where we look for businesses that are being mispriced by the market and give us a good margin of safety with lots of opportunity for growth and expansion. Currently, I'm going through the process of kind of altering/adjusting my portfolio from when I started, which was more dividend investor base, which is what pretty much everyone on the internet is, to more of, like I said, a value-based investing style.
So here's a question. We're actually going to take a little bit of a pot shot at the dividend investors real quick, and
sure.
not to super bash them, but dividend investors. Did Ben Felix's irrelevance of dividend relevance change your mind at all on this? Did you watch that podcast or listen to that?
No, I saw someone mention it today on Blossom, but yeah. I didn't see it. I don't know anything about it.
All right. Well, I got
my opinion on dividends has been ever changing over the past 10 months, and I'm still working on getting out of those high yield, non-valuable positions myself.
Okay. So I will say I would say a dividend investor, but I try to keep the dividends between 1% and 3%. Unless it's a REIT,
sure.
And that is because I really do believe that when you're paid a dividend, that's your guarantee that you've been paid by the company. If
right.
That makes any sense. So you're guaranteed a yield.
Yeah. So if you look through your portfolio, you have a lot of mega caps on here with stuff like the major banks. Microsoft is another good one that pays a dividend. Apple's on there. Berkshire doesn't pay a dividend.
Nope.
But you have some large names here who they're at the stage in their companies where they're not growing as fast as they always have.
Yeah.
So they are generating massive amounts of cash that they need to
get
do
paid
something with, right? So
Yeah.
a dividend is just one way for them to allocate capital. That's pretty much what a dividend is, right? It's money that a business has been able to raise that they need to decide where it goes. If a company's in the early stage and they want to grow, think of like, I don't know, Shopify or any other business that doesn't pay a dividend. These companies are going to try and take as much cash flow as they're generating and fuel it back into their business, right?
Yeah, 100%. So I guess I could just explain the portfolio real quick. This portfolio is trying to be 50% ETFs, and that does include Berkshire Hathaway because that's how I see it. 50% ETFs, mostly XEQT and BRK.B, and then 50% hand stock picks, where I'm trying to beat that other 50%, if that makes any sense. So
so it's like an inner contest,
exactly,
within your portfolio.
Exactly. So what I'm trying to do is I'm trying to build a hand-picked stock ETF basket that is going to beat my ETF.
Sure. Well, you're up against Warren Buffett, so it might be quite the challenge.
Hey,
but
man, listen.
All the power to you.
He will die soon. Don't worry. I got the edge.
There you go. You got time on your side.
I got time on my side. He doesn't.
That's for sure.
So let's just go through. We got I guess we'll just talk about the losers. I was gonna say one that stands out to me right away is Algonquin here. Man,
obviously, talk of the town. Everyone's got an opinion on Algonquin.
And the problem is that Energy's been doing well and Algonquin's been doing terribly.
Right.
So
it depends on how you see Algonquin, right?
Yeah.
Energy has been doing well because oil is doing well.
Fair enough.
Algonquin's not in oil. They're in utilities and they were in renewable energies.
Yes,
right?
They were. Mm-hmm.
With that segment of the business selling. Now, I know Algonquin kind of became the icon in the YouTube space because of its renewable energy going to change the future hype behind it.
Yes.
Now, you see it in pretty much everyone's portfolio. The question is, are people still holding it? I don't know. I held Algonquin myself. As soon as they made the decision to sell off the renewable assets, I decided that was enough of a change in the business that it wasn't something that I'd be interested in holding anymore.
Okay.
Had nothing to do with the dividend, just had everything to do with the business had fundamentally changed, so it wasn't something that I was interested in. So my question to you is, with everything that's changing within the company, you're still holding it, so there must be a reason.
Kentucky Power.
Yeah.
They're still trying to grow. I would have loved to see them cut the dividend even more. I know they did a 60% cut. I would have loved to see them just say no dividend.
Right.
But that's, I guess, just not the company they are. So even though I still hold it, it is a bit of a stain on the portfolio. And I should have, honestly, I still think I could have averaged down, especially when it was at its lowest. But it is something that I've planned to let sit there and rot, and then take a look every so often to see what's happening with the debt.
It's a lesson at this point.
It's a lesson. Yeah. Sometimes I keep big red marks like this. Obviously, I have 87 shares and 1,400, so it was a 3/4 position. So the way I usually do this is my first position is 500, next one's 1,000, and then another 500, so 1,500. So I usually go in $500 increments, and that's just because I'm trying to dollar cost average into stocks that when I think they're at a fair value, I buy my tracker. I buy one share, and then when I see them drop from there, I see some bad publicity come out, because when things get bad, they go worse. Algonquin was one of those that I think I was just like way early on, and also
it just kept getting worse.
It just kept getting worse, and I didn't see it coming. When they cut dividend by 60%, I'm like, thank God. But then they also made a huge acquisition, and now they have crippling debt. So that's just
the Kentucky Power acquisition, did that? I don't think that ever went through, did it?
I believe that it didn't. I'll have to take a look at that. This is it's been a long time since I looked. It's been staying at 40%, so I guess I took it off my radar for almost a year.
Right. It was my understanding that they made a bid to make the acquisition, and then the acquisition didn't go through.
Yeah.
And this was after Algonquin had taken on debt and issued shares to finance the purchase. And when it didn't go through, that kind of set everything back, seeing as they had diluted shareholders and raised extra debt, and now they had nothing to do with the money.
Simple
in a high interest environment, right? So,
to be honest, I think I went outside of my usual. Like, I should have just taken a look. Are they buying back their own shares, or are they diluting the crap out of people? They're diluting the crap out of people. I should have stayed away. It was that simple, and I made a mistake.
Dilution is
key.
The tax that we all don't know that we're paying.
Yeah. Again, that's one of the reasons why I don't put so much money into each position. If that makes any sense. As we go down.
Sure. Let's get on to the next one.
Right? Yeah, next one. Algonquin Power. That is such a popular one on Blossom, so it is good.
And that's the main reason I wanted to touch on it, is just because it is such a hot topic piece. The rest here, Apple, obviously, solid business. BlackRock's a little interesting. I think there's pretty much 3 businesses in the BlackRock space. Not much to say other than that.
Yeah, BlackRock actually, not much of an investment thesis on this one, which is weird for something that I have so much money in. But it was below its historic average price to earnings. Everyone was freaking out because they think BlackRock's going to take over the world, when that just is not how that works. It just straight up is not how that works. Because they're an asset management company. They don't own said assets. They manage said assets. So, like, people are misrepresenting the business, and I seen that in media, and I thought, $550 for BlackRock, that's a bit of a deal.
So my question then to you would be, why BlackRock in USD over something like Brookfield?
I know everyone's been kind of jumping on Brookfield Asset Management. I think it's because I like BlackRock as an evil company.
You're the villain story.
I like the villain story. I like the idea of these monolithic, masters of people trying to push companies around. I like that idea. I also like the fact that the CEO is just a money hungry man. Like he doesn't. There's no morals behind it.
Right.
If that makes any sense. And that stands out to me because I like that. I'm a very, I guess we could say, moralist creature when it comes to this stuff. Money's first. I'm here to make money. I'm here to make money. So BlackRock is also here to make money, and therefore they are like me.
Your goals have aligned, and you know what? That's great that you find positions that your personal goals, objectives, and morals can align with, and you opt to support those businesses. I can't fault you for that in any way.
Yeah. Brookfield Asset Management, though, honestly, it just slipped away. I guess I was just sleeping on the news. It's something that I was, like, I glanced at by accident, and just something that I never heard. And it happens because I'm not always like present all the time. If that makes sense.
I wouldn't say that it's completely gone yet.
Oh yeah, okay.
But
all right,
maybe
no. I'll take a look.
Maybe take a look at it. Yeah.
I'll take a look. That's a good hint. That's a good hint. All right.
So Berkshire says enough about itself. I think everyone should know what Berkshire's about.
Yeah. They don't pay dividend, but they reinvest their money. I look at it as a price to book ratio is like the key metric I use to value it.
Yeah, that's what Warren does.
Holding company. Because it's a holding company, you measure it based on its price to the book value, and therefore I am trying to buy it at usually 1.2 to 1.3, and right now I do believe that would set it around $300. So if it hit $300, I would probably double up on this position and put another $3,000 to $4,000 in.
Well, there's actually an interesting statistic where in market corrections, typically Berkshire falls more. For whatever reason, it doesn't make sense, because if you think about the cash that they have, the actual value of the assets go down half, because
they're mostly in
their
cash
balance
holdings.
sheet is so heavily weighted in cash.
Yeah.
So I mean, I think 1.2 is a great target for price to book.
Yeah.
Warren has said himself within his annual letters that 1.2 is typically his share buyback price. So
yeah. Now I do forget the name of the other two people stepping in for Warren Buffett and Charlie Munger.
Yeah.
But I can't remember the next two leads, the two financiers they have working under them, but they also buy shares lower than Warren Buffett.
Yeah.
Which
Absolutely.
is funny. So like, you know, if there's anything that says, you know, a little stability in the way those guys invest and how they align with Warren Buffett when, you know, God forbid that man dies because he is 96.
It'll happen someday, unfortunately. But
it will happen in my lifetime. But I believe that will just be a buying opportunity.
Yeah, honestly, the share's going to get absolutely decimated.
Yes, 100%.
When he dies, I would think.
Yeah, maybe that's why they're saving all the cash.
Maybe, but I definitely think if you understand, I mean, I still think that you have to understand Berkshire to some extent.
Yeah,
it's more than just the assets that it reports on its 13Fs.
Yes.
It's a huge insurance conglomerate.
Yes,
like
they have
own
lots
Dairy
of other
Queen. They
companies
have
under them.
Yeah, exactly. They've got it's a huge web of businesses, and you have to understand that.
Yeah.
And with that, you have to understand that generates a ton of cash flow.
100%.
And cash is king, right? That's how they've accumulated the amount that they have. And that's not going to go away if Warren Buffett dies.
And and they become more or less like I would say like a toll booth company.
Oh,
themselves,
absolutely.
where they you know, that's insurance, right? They're an insurance company.
Yeah.
So, yeah, Berkshire Hathaway. Enough said. I like
Perfect.
it.
Yeah,
I like it.
We can move on. No point in talking about stuff that you only have one share of.
A Caterpillar.
I small portion sizes.
Every time I look at it, it was the tracker share, and it dropped by like 20%, and then I didn't buy more, and then I feel bad about it. So that's a lesson learned on what could have happened. So one share means that I was looking at it.
Yeah, exactly. Dollar General. I don't follow this one personally, but
crippling debt.
I've heard it in the news a couple of times.
This is what I'm hoping that Algonquin. This is where I was where I'm jumping in on Dollar General is where I wanted to jump in on Algonquin, if that makes sense. Crippling debt. It's a turnaround story, but it also, you know, it's a like a discount store, you know, coming into a recession. Yeah. So, you know,
that's a scary one, because especially in our current environment, it's very easy for a company to just say, hey, we don't want to pay our debt anymore, let's file bankruptcy and wipe everyone out. Look at any of the airlines, right? The airline industry is cyclical in the sense that a business will last for 10 years, declare bankruptcy, start over, but they don't have to flush out their assets, right? So airlines are a dangerous place to invest, in my opinion, because shareholders are not even considered at any point. Look at if you look at Air Canada.
Yeah,
I see it all the time. Oh, it was such and such a price prior to the pandemic, and get back there. But then when you look at the market cap at its peak and its market cap now, it's essentially at the same place, but the share is 50% less, right? Like, share dilution is definitely something to keep an eye on. And you want to be careful with debt.
Dollar General has always done a good job at buying back shares, but it is a turnaround story. I do know they have high debt. I've taken a look into it. I'm also here for a turnaround story. It's also not that much, if that makes sense.
So when you're looking at debt, how do you justify the level of debt versus what
so
metric?
Right now, this is kind of the maximum. They have 100% debt, so what they have right now is not going to cover what they have cash on hand is not going to cover their debt. So
do they pay a dividend?
Pardon?
Do they pay a dividend?
They do 1.5%.
Right. So now you're questioning, does the management team have a proper understanding of what's required, even though it might be something that they don't want to do?
Everybody, like up until probably 6 months ago, everyone was calling this company like the best. It was a.
Well, I'm sure they were hand in hand compared to Dollarama and whatnot, because all these stores are
Ripping. Yeah, I have Dollarama too right here.
I see that down there. Yeah.
If Dollarama came down like to $80, I could justify it.
Right.
Over Dollar General, but I was looking for a new stock, and Dollar General was like, oh, people are talking about it. Let's take a look. People were talking about it a while ago, so let's take a look now.
Right.
So
yeah, I had an average cost on Dollarama of $45.
Oh,
and,
nice.
Too bad I sold it at like 50.
This Dollarama, 53 is when I got it.
Yeah.
So
it's a great company, absolutely, and it's definitely had a great run.
Okay, so yeah, Dollarama.
We'll keep going there. I see some real estate in there.
You do. Dream Industrial.
Yeah, I'm a little familiar with Dream. I used to hold them a while back.
Yep.
What's the thesis here? What are your thoughts on real
here
estate?
Was they have long-standing industrial REITs that weren't going anywhere, and everyone was talking about real estate like absolutely crumbling. And I know industrial does take a harder hit than most coming into recession.
Right. But, now, correct me if I'm wrong, but Dream is a spin-off of Magna, is it not?
I believe so.
Okay.
Oh, I'm not. Yeah, I think so. Yeah, because Dream Industrial is a spin-off, and there's the Industrial, Commercial, and Resi REIT. So
yeah, and I would think that the Industrial REIT, I know in the past when it got spun off, and this is back when I was holding it, it had like 60 to 70% of the tenant space was Magna, if I believe I'm correct there. I'm a shareholder of Magna, so I didn't want to have the double exposure in that regard, but I definitely think it's a pretty high quality REIT. I don't blame you for holding it. You're sitting at a nice 12.5% there. Can't complain about that.
Without dividend yield,
Without dividend, exactly. And if I'm correct, I think it pays around a 5% dividend.
Yeah, 5%. I am I just bought 5 more shares. I am currently in the process of reinvesting those dividends to start compounding. Is something that I've been pretty bad at. Absolutely. Been reinvesting the dividends, so.
Just remember that you can compound. Compounding isn't limited to dividends.
Yeah.
Businesses can compound within themselves. And if you look at your return on equities and return on invested capitals, that's the rate at which businesses are putting money back in and how much they can get out of the reinvesting. So it's important to keep an eye on internal metrics, not just what you receive cash flow wise.
Yeah, dividend is not king.
Exactly.
In this case, for a REIT, I do look at it that way. One of the reasons why I try to keep dividends between 1 and 3 is because I don't want them to pay me too much.
Right.
So we're actually going to find a company that did pay people too much. Intel.
A little bit down here. So yeah, you got a couple big names down here: Google, Home Depot, Intel, Meta, even Manulife. I'd maybe throw in there. These are Microsoft. Maybe. All pretty, maybe Manulife doesn't make the same cut as Meta and Microsoft and Google. Cut them out, but some big names here, and they seem like pretty healthy
Joseph Carlson
sizes.
Joseph Carlson sold me on the idea. Again, I get my information from sources, and that's what I do my investing based on. These were basically the value of tech was in big tech, which stands true. QQQ.
Absolutely. Magnificent 7 is pretty much all.
Yeah, 100%. So I look at big tech, and I thought, Google, I may have jumped the gun on that. It did drop down to, when I bought it, it was $2,700 a share. That was before split. So when it dropped down, I did reach a low of 75. I do believe I bought it at 80 or maybe 85. So this is one that I did average down in quite a big way. Obviously, I have. I
mean, you're sitting up now. It had its good opportunity. 18% is nothing to complain about.
I took advantage of the good opportunity. Again, buying big names at value. I got better at it. So
there you go. High quality names. That seems to be what you're looking for.
Yeah.
I was in Google as well. I didn't have near the size of position you had. My Google position was more on the test shares type thing.
1 or 2s.
But I ended up selling out and got I think it was like 45% return on it. So
fantastic.
That was over 8 months, I believe. So not bad.
Very good.
But it's definitely had a run, and obviously it's a high quality business. They just announced recently about their new AI that's supposed to be coming out.
Bard.
I don't know if you've looked into that. Well, no, not even Bard. A new one since then.
Oh, they have a new one since then. Okay.
Yeah, it's supposed to be competitive with Chat GPT-4.
So very cool. Maybe well, Meta's got the language model one too, which I think is a little more unique. I like that they took a different spin on it.
Yeah, I've not been trying to chase the AI.
Honestly, these names were by accident. I bought these names pre-AI.
There you go.
Yeah. So I haven't chased them up. I don't chase. So Manulife Financial, very nice for the dividends. Thank you, Manulife.
Yeah, that's pretty much all it is. If you look at the chart, it's pretty much traded sideways for the last 10 years.
As it goes sideways, I always try to buy below the median price. So
yeah.
And I will continue to do so. Right now I'm up, which means no. Home Depot, I would like to buy more. Every time I see it at like minus 10, 12%, I'll buy a more. But yeah, I think they're a little pricey right now. So
yeah, definitely a high quality name.
Yeah.
One that stands out to me, Meta here. I just wanted to touch. Your average price is quite high compared to what we've seen in the past. Past year. So were you taking advantage of the opportunity when it was down around $100 or whatever it was?
This is actually where I found out how stop losses work. Not stop losses, limit buys. So I bought Meta. My first share, I think I started at 300. I might have started at 300. Let's click into this. My first shares, I started, so probably 275 is when I started buying. My first share, my tracker share, it had continued to fall that same day by another 40%.
Oh, wow.
Because I set a limit buy, my order filled on the way down. Had I not done that, I would have bought 50% lower. So, yeah.
Using a limit order or versus
using a limit buy, yeah. Because you're basically saying I will buy it at this price, and then when it hits
limit buys typically. Yeah, I'm not a clearinghouse, so I don't know for sure, but it was my understanding that if you use a limit buy, that's the maximum number of shares, and if you use a market purchase, it'll just be whatever the price is, give me it for that.
Yes.
So limit buys, they still typically.
I set the price for 270 when it was when it was 340. I set the price for 270. So it fell through my price down to 190 that day.
Right.
And I had taken a 40% loss in 4 hours.
Woof. Yeah, that's a rough one. I try to not let orders sit stagnant. I know my price targets on things, so I'll monitor stocks, and if they fall to that price or they get within that range, I'll just execute an order at whatever the price is currently.
So like, okay, I get you.
Then I typically don't get caught with
things like that.
Huge gaps between market hours or anything like that.
Yeah. I do that now. I do what you're doing now, but it wasn't always that way. And it sort of stopped when Meta happened.
There you go.
So I am up 60% on this position now, but just so you know, this is actually 100% difference from when I started.
Yeah.
So I did buy more shares as it went down. When it was at the lowest, I think I caught the lowest by like 3%. So
there you go.
Yeah. You
can't complain about that.
You get better at it, right?
Yeah, exactly.
New tech. Let's talk about new tech real quick. First, one of the first things I invested in, huge dividend. They pay 9%. That must be great. Not that great, as it turns out. And this is after they've already run up. Like, I usually sit in this position at a negative 60%.
There you go. So it's recovered quite a bit.
It's recovered quite a bit, and I'm still negative 35%. Yeah. Yep.
Okay.
More
real estate down here.
Lessons to learn. Nexus REITs has a very, very high payout ratio, so I'm a little afraid of it, if I had to say so.
Like above 7.
Yeah. and I would not like that. I would like it more like Dream Industrial. So we're gonna sit on that and see. If you haven't noticed, I don't sell anything.
Real estate's in an interesting spot right now.
Yeah, I don't sell much. I think I've sold one stock in the history of this portfolio, and that was Figs, which was a total hype stock. I actually made like 20% on that too, which is
well, that's probably for the best.
I shouldn't have. Yeah, this was supposed to be a buy and hold portfolio. I believe the YouTube video I watched when I decided to make my channel, they called it a coffee can portfolio, which was buy everything, hold it forever.
Yeah. And so, do you know the origin story of the coffee can portfolio?
Oh, you do? Oh, you have heard of this? Oh my God!
Oh, absolutely.
You're the first person I've ever said that to. Is like, oh, I know that.
Yeah.
Oh my God, this blew my mind. All right.
Yeah, the idea that.
Wasn't it this guy who started accumulating stocks next to a fund manager and ended up outperforming him by holding everything that the guy sold?
And every time that this fund...
Oh, hello? You broke up. Hello?
Fund and the husband was that the mutual fund would be in and out of positions, but the husband never sold. And the net result was that the husband was way better off than what the mutual fund manager ever was.
Yeah, so that is the idea of this portfolio. By the way,
absolutely.
BT Dubs. This is why it looks the way it does.
Yeah,
it'll get better, but I will get better over time.
For sure.
So that's the coffee can, and then I guess we could take a look at. I guess it would just be XEQT left.
Well, I got to point out first, Vanguard dividend appreciation.
Yes. Right.
We were just bashing on dividends earlier, but here you are.
Three of them. This is the coffee can stigma that happened. If I could, or rather if I could always, but I would rather these just pile into XEQT. And actually, this was a part of my original thesis, which used to be VIG, which is way worse. Because not VIG. There's another Vanguard dividend portfolio that's very common. I can't remember the name, but anyways, it used to be a different ETF that was about $44 a share, and I took a profit on that. I think I made like 8%, but I didn't like it as much as the Vanguard dividend appreciation ETF, mostly because VIG held a lot of Home Depot, Microsoft, Apple. So like we are doubling up on stocks quite a bit here by owning VIG. But
gotcha.
I didn't. Yeah, I would much rather flip these into XEQT shares, but now that they're here to stay.
Yeah.
So yeah.
Yeah.
I'm gonna shit on dividends a little bit, but this is here for a reason, and that's because as I get older, my thesis changes, and this is a part of that change.
There you go.
Yeah.
Walmart. Huge company for sure.
Yeah. They went through bad news, which is why I'm 24% up. Again, a little taste of trying to be a value investor. Walmart was, they're going to close down. They got high debt. They got all these things. And they went down 25%, and I bought. So, there you go. They haven't really done that much, though. So, it is a stagnant position. It is a position that pays me a very, very light dividend. So it is here to stay. And if anything changes in that, I would be right there to take a look.
There you go.
XEQT.
And then, there you go.
Yeah. Do you like XEQT?
To be honest, I'm not an ETF guy.
Okay.
I don't look at ETFs. I held VFV for a while, but I used it more as a temporary spot to hold my cash. I was in and out of VFV, and
I was very proudly one of the first 100 people to watch your video.
Rate it, but
I did. I watched your video on
there you
VFV
go.
And how.
Appreciate that.
Yeah, VFV and how holding. Underlining CDRs is not as good as the current overarching stock if you hold it for more than 5 years because of what they charge. So I was there. That was a good video. That was very insightful. I kind of already already knew that. So
absolutely.
I don't have. You can kind of already see that I don't have any CDRs, but your video had just sort of proved that my thesis was very well thought out. So I appreciate that.
Yeah, that's good.
And you don't have any ETFs? Why not?
I just personally
Hello? Oh, I think you're gone.
Average market return is not something that I'm looking for.
Yeah.
So they don't. Here, give me 1 sec.
Yeah. So you're looking for
Is that better?
Yeah, that's way better. Or maybe not. So you're looking for.
I'll just say that again.
Yeah.
Yeah, so I don't hold ETFs because typically an ETF is a good way to mimic the market, and
you're looking for better returns. I think that once you start saying that sentence, your voice
quality companies that'll help me.
Yeah. 1 second. Let me try resetting. Can you hear me? Is it better if I do it? No, you're still gone. Nice. That's alright, we can edit this out. Yeah.
What?
You gonna help me edit this out?
Are you done? Or are you still talking?
Probably 2 more minutes. 5 more minutes. And then I'll be done. However, you are gone still. And I cannot hear you. Oh, he's typing. Uh-oh.
How you say goodbye?
No, not yet. Hey, there you go.
Yeah, you were cutting out for a bit there, so I didn't want to interrupt you in your video.
Fair enough.
But
you're looking for better
Yeah.
returns than the average, right? Than the average market.
Yeah, I'm looking for higher average returns, and average index funds is not going to get you there. If you look
You're gone.
at most large investors, although, I mean, you look at Warren Buffett and he says, okay.
Yeah, no, you're back.
Is that better?
I think so. Yeah, let's try that.
You can hear me?
Yeah, I can hear you.
Okay. Yeah, so if you look at any of the large scale investors, look at Warren Buffett, they'll often say index funds are the best spot for your average investor, because most average investors are not going to put in any time, any effort, any real work to finding quality companies and actually keeping up with them. I think that it's very possible for people who are your average retail investor to be able to put in some work and have an understanding of the markets and businesses and finding real value. And if you can put in the proper amount of work and you have a good grasp on the businesses that you want to hold, then there's no reason that you can't put yourself in a position to outperform the market. It's done time and time again. I know the argument is always thrown out, well, if you think you can do it, why don't mutual funds do it? Like, why do most mutual funds underperform the market? And it's a simple fact of small people in the investing space. So you and I, retail investors, we play a different game. We're on a different playing field than mutual fund managers, because most of the time these fund managers, they have quarterly quotas to uphold. They need to satisfy customers, and they need to constantly be in and out of positions so that people are happy, right? Nobody wants to. They don't have the ability to sit through downturns and ride them back up, so they have to try and time in and out of the market. Everyone always says better time in the market than timing the market, and mutual funds don't have that privilege because they have such pressures from their investors. So
fair enough.
That's why they don't outperform. It's pretty obvious, pretty simple. That's why people like Warren Buffett do, because they don't have investors that they need to care about.
People.
So
yeah. Fair enough. Well, I always I'm a little, I guess, hypercritical of Warren Buffett, because he always says that you need 5 or 7 companies that you know very well, and then you look at his portfolio.
Yeah,
and it's pretty huge,
right?
You know, like it's not 5 or 7. He owns like 25, 30.
Well, you have to understand that really he doesn't, because
Yeah, he has lots of people that work with
he
him
has
that
others
fix these.
investing
Yeah.
for him. Yeah.
Now we know why you don't own ETFs. I can explain to you why I own ETFs, because I'm an average person and I want a bit of the edge taken off to my personal stock picks, just to take the edge off me. You know, this is like the retirement fund, and then this is like trying to beat the retirement fund. You know what I mean? So that's kind of the way that I play that. Might not be the most popular
absolutely.
style, but
It's good to have a plan either way.
Yeah, it's good to have, like, I guess you could say XEQT is a backup plan.
Yeah, it's always good.
Yeah. So, all right, before we finish up, let's just have you rate my my portfolio. What would you say?
Yeah, if we were to rate it, I think you are. Oh, that's a hard one.
Yeah.
If we were to put it on a scale of 1 to 10,
Yeah.
I think that you have a pretty solid base. You have some really high quality stocks in there. There's some lower quality stuff that I'd probably recommend trimming.
Okay.
Yeah, I'd say you're probably sitting around a 7 or an 8. You definitely have some spaces that you can probably focus a bit more.
Yeah.
But I think that in terms of having an idea of what you want your portfolio to look like, you have a strong grasp of that, and you're executing that pretty well.
Well, thank you very much. Well, thank you very much for your time, man. I appreciate it. And again, Bradley from Blossom.
Yeah, for sure.
I appreciate Bradley Talks Money. If you haven't had a chance yet, his link to his YouTube channel will be in the description. It'll also be on Blossom in that description too. I don't mind. I would love to see. I'd love to see more people check your channel out. I think that you are an interesting guy. You are posting very quality content on Blossom, which is very rare to see. So I appreciate everything you do for me on here right now and on Blossom. So thank you, Bradley.